When pro cons versus the different types of lenders, PE, specifically more institutions versus PEs versus VCs.
So in the category of service businesses, LBOs or leveraged buyouts exists in both private equity, but also is a good vehicle because we want to retain as much control as possible.
Welcome back to the Scaling Fast Lane. I'm Valerie Booth. In today's episode, serial entrepreneur Peter Lang takes the hot seat to tackle tough questions on funding, team building, and selling your vision to investors. From financing options to insider tips on building an A team, you won't want to miss this exclusive glimpse inside Lang's proven acquisition blueprint.
All right. So first one, seems like banks are pulling back on lending, SVB, economic changes, things like that. Are there specific types of banks or lenders that you're finding better than others right now?
Yes. So when you look at the people who pulled back, right, it's because their LPs or the money came from a certain category of investors. So Silicon Valley Bank had what kind of category of investors? Tech investors, right? And so when you look at the consequences is if your LPs were also investing in tech, then the people who are leading those tend to get a little bit nervous because their LPs are like, well, I've lost it here, I had it hung up here. But most of the people who have been impacted are strong enough investors to where they're fine. There's not a lot of casualties yet. When you look at being pulled back, it's in regards to terms. They will use it to negotiate more warrants in the business from a debt perspective. Everyone knows what warrants are? No. Okay, warrants is essentially equity, future equity that can convert. And so because of uncertainty, the same way we use uncertainty as buyers, lenders will use the uncertainty to get more aggressive interest rates, more aggressive warrants. They'll be able to, because you want access to their money. So it hasn't changed as in available funds, but the way that they're making it available is less appetizing to more people raising funds.
Gotcha. And are you guys mostly using larger institutions or local banks?
Well, no local banks. So Tom, his bread and butter, I mean, he's raised money from a lot of ways. We did initially convertible notes. Everyone's familiar with convertible notes? Friends and family round. So in a friends and family round, you would typically create a convertible note. People can invest. It's essentially converting at a future date, so you're not diluting the business. But when it comes to our debt partners, maybe Tom, are you mic'd up? Tracy, can you talk? Mm-hmm. Great. Maybe talk about our preference for mezzanine debt.
Okay, and I'm going to take a step back and just some clear. Sometimes you hear, when you're raising money from individual investors, you can go out and you can set a share price. Now again, if you're ever raising money from individual investor, use an SEC attorney because you can easily get into trouble with investors. And therefore I say always use a great securities attorney that will help you out and guide you there. Okay, to start with. You can always
use specific attorneys for all bits. Transaction attorneys do M&A, buy and sell. General counsel can do business formations and organizational structures. Then you have SEC attorneys. You want people who typically defend and represent clients within the categories you need help. That's not just one lawyer.
Because what I try to get from attorneys is give me the law, and I don't want an attorney to have to call 3 other attorneys to get the advice. I want them to know the answer, and I want them to help me understand the risk based on their experience, and if they're highly experienced and they're involved with litigations, they know what can create issues and risk for you not. I know this after spending probably about $5 million in attorneys over the years, mostly to prevent things from happening. Yeah. So again, I've over-indexed and I got my own law firm of Shipley & Shipley from this. So with
which now I'm a partner of. It's Shipley Lang.
Yeah, Shipley Lang now. So
we spend enough on attorneys.
So what I'll share with you is, so from an individual investor perspective, you can go out and set a price for your business, and you can, again, set your share price and sell it through just straight equity, okay? As you're growing fast, the question is are you giving away too much equity in your business by doing it? So one way of doing it and helping bring investors in is, like we did, is you can create an instrument that's either called a convertible note or it's very similar to a SAFE, S-A-F-E. Very, very similar construct, okay? And what you're doing is basically saying that when our business hits this threshold, and you can say the threshold is whatever it is, you can choose to convert at that time or at that date for a certain value. But until that time, I'll pay you 8, 10, or 20% interest per year. So they know as long as they have their money in, is they're making interest. And when that happens, they get their money back. And they don't, well, they can either choose to get their money back with their return or they can convert it. You can create with your attorney any features you want to. They're forced to convert. They can have an option to convert or take their money out. You can have a lot of flexibility. That's why if you have a really good securities attorney, they can structure that. But our goal was we didn't want, when you start.
And that's from accredited investors, let's be clear. And you have to have the accreditor investor evaluation done by usually a third party. It's really recommended. And we use our firm, that's the SEC attorney, to be the accreditation confirmation.
Okay. We can go into a lot of detail. I'm so tempted to talk about Reg A offerings, Reg D, but we're not going to go there, okay? So as far as how to raise it from individual investors. Now, my favorite instrument, I said this before, was debt and mezzanine financing again. A great way to get started, and Shane, I believe, used this as SBA financing, correct? Again, there's some caveats to this. You need 10% of the enterprise value in cash. You need to have personal guarantee on it, so some caveats, but from very efficient capital, it's a great partner. There's also some quick loans that you can get for lower dollars, like the transaction I was showing. You can do a quick loan through the SBA for $350,000 again. So there's other instruments out there. There are some other things that you can be creative on your balance sheets. Again, if you have receivables, you can get, and again, you can. We don't have inventory in this business, but from there are asset-based lenders that you can borrow against your receivables and potentially with the company you're acquiring. One of Peter's favorite things that he loves to do in deal structured is cash on close delayed by 30 to 60 days or up to 6 months.
Deferred down payments.
Deferred down payments, okay? So, but what that allows you to do is buy the entity, if they have assets like receivables, is you can go and put your receivables together with their receivables and then go borrow up to 85% against them, which might give you the cash you need for close based on the deal you construct. So there are ways to do that, okay? But from an SBA perspective, those are some flexibilities of how to come up with cash.
This is called pre-closing funding techniques and then post-close funding techniques. And oftentimes you can't get funding until you own the business, and therefore this is a post-close funding technique.
And then from, as we were talking about, is banks getting a lot. For most businesses, you can get bank line of credits, which are great, but the dollar values are small on a relative basis. But that can also help fund acquisition depending on the size. You can also use your bank line of credit and you do the acquisition. If your down payment is due 30 days later, get a bank line of credit also on that business. And if you have a great relation with your bank, again, you can use their historical cash flow years on that. There's some other great lenders. There are bridge lenders out there that will give you, I met one, they give you, the deal is it's pretty high, the amount of cash they're going to upfront you. They do a 12 to 8% or 12 to 18 month amortization with about 12% interest. So it's monthly payments over 12, but for the initial payment, it's expensive, but it's a great initial payment. Or mezzanine lenders, which is they take a little bit of equity and debt. So there's just some of the flavors of ways to structure. We can talk after the fact if that was what you're looking for.
Cool. That was probably more than the question, but we all like that amount of information, right? Yeah.
Building a pitch deck for investors, if you're trying to do a family friends round type of thing.
Yep.
What's the most important elements inside of a pitch deck and what's just fluff?
So it's very interesting, right? When you think about a pitch deck, you think about what you're trying to communicate is trust, legitimacy, and then the return. And then you have a crap ton of references and exhibits tied to it because everyone's trying to get it less than 10 slides, right? So when you're doing a pitch deck, you have to think, as an investor, what are they going to care about? They care about, is the people running this good? Can I trust them with my money? Have they done it before? What happens if you've never done it before? You don't get funded, right? It's higher risk. Now, Tom raised $100 million with a pitch deck and no business model. And it's because in that deck, consistently, when we raise money, it's laying out clearly how they make money and the opportunity. So the number one thing is how clearly you communicate the opportunity to the market. If you can't, if it's not simple, remember I talked about the narrative, right? The narrative is the most important, not always the numbers. Now, you also have to have people who can back it up with the numbers. We also like to highlight not just executive team, but any IP. So for us, that book in front of you, right, 2Y3X, it's very important for investors to know that with the use of funds that we would be deploying in acquisitions, we have a documented commercial program that will yield consistent results. It has to be simple, easy to understand, especially if you're raising money to do deals. Now, if you're raising money to do deals, you can do it at a few different levels. You can do it the overarching business plan, which is growing through multiple acquisitions, or you can do transaction-specific fundraising, right? So transaction-specific would mean you have a deal in front of you, right? And there's some difficulties with that because you're rushed. You have an LOI. You say, I got a deal. Here's how I need investment to close this deal. Here's my gap, or here's how much I want to raise. But you have a window to get them committed. And it takes a bit to close financing. It can take 90 days. It can take a little bit longer, depending on how mature your business is. So you have to be very careful being a transaction-funded business model, because you're working to get an LOI, then you're chasing money. Getting an LOI, chasing money. And it has to be something that you've done before, so you feel comfortable. It's a repetition that you're confident in.
When pro cons versus the different types of lenders, PE, specifically more institutions versus PEs versus VCs.
So we like debt. So in the category of service businesses, LBOs or leverage buyouts exists in both private equity, but also is a good vehicle because we want to retain as much control as possible. When you get, all of you are free and you run your own businesses, right? You're entrepreneurs? Mm-hmm. Or do we just feel that way and we work for our clients? You work for the money, always. Whoever's giving you money, you work for, period. You work for your clients, you work for a dozen people, 100 people. You go get money from outside institutions, you work for them. So from our perspective, if we wanted to remain in control of how we were going to grow and use the funds to have an impact, we needed specific funding sources that would be okay with us having control. And that's debt. When you get into institutional, you get into private equity. Darren can talk. Private equity care about the color of your logo. You don't hit your performance, they'll yell at you. They'll show up and say, this is, what are you doing? My investment, this is our expectation. And they'll replace CEOs and executive teams because their job is to work for the people who they got the money from. So from our perspective, within the category that we're teaching, debt is a very good vehicle, especially if you want to retain the creative control over the business, over who you can acquire, and the scrutiny behind it.
Nice. When building an acquisitions team, really, who would you say are the required roles that you need on the team, and how should they be compensated? That's
a good question. Number one is you need someone who will take the phone calls. Right? If you're going to have, Tony's a great example. You need someone who can talk to 8 people, 8 sellers a day and not be phased. Really, it's a true sales type. You also need that person to be from the industry. We see the highest conversion rates from our outreach from people who look and are from the same industry, who look like them and are from the same industry. If you're from oil and gas and you shoot Ellen a LinkedIn message, she ain't responding to an oil and gas person, even if it's a compelling message, because it just doesn't feel right. So typically your head of M&A or the person who's doing the vast majority of your interactions with sellers should be the industry person themselves. So ideally someone you bought. Have you ever had a client become a salesperson for your companies? Mm-hmm. The case study is selling? Yes. When you can have the case study interacting with prospective sellers, well, I don't know about selling to you. And they go, well, I sold to this. I joined. It gives you a much faster rapport than any other. The next one is you need someone who will do list generation. AI tools are great, but at the end of the day, if you can hire someone offshore, Serbia, South America, to do a lot of the interaction. I've had my LinkedIn managed for over 6 years now, maybe even 7. It just frees up capacity. And then you train them and they become a team member and they're learning to communicate. So those are the first 2 roles. Compensation in corporate business development is really hard because you don't want to incentivize them like a broker because that means you're spending more than you'd like for the business you're buying. So typically you have to just compensate extremely well. And then you figure out other divestiture or exit bonuses that you can give them. But you just, at the end of the day, corporate business development, you pay them extremely well. When we sell, or as a company, they get that distribution. But you have to be very careful incentivizing bad behavior. Have you heard that term before?
Yeah.
And incentivizing bad behavior in an M&A team is them trying to make the transaction as beneficial for them and not the parties involved. All right, it's not brokerage. They're working with you as a part of your team. But those are the first two positions, and that's usually enough. Then you expand in that. So you can add an M&A associate as the third hire or the third role. An M&A associate is going to be someone who takes the initial first two qualification calls and then tees it off to the person who's running the M&A program or is head of corporate business development. And then you just expand your team from there depending on the volume of transactions or how big the target audience is, right? Total addressable audience can be massive, and you just sift through that requires you to have a sales team. That's why Tony, who's run big sales teams, knows how to organize the team for the most efficient interactions with prospective sellers. And that's typically who you're looking for. And you also have to have someone who wants to do deals and likes interacting with sellers, who's been there before as well, so they can spot the tire kickers. At the end of the day, where you waste time with any sales activity or with people who won't buy, who are just using the discovery to learn more.
And then the finance side of it, have you found good outsourced companies that can do that, or is that something you should have in-house?
For accounting and finance?
Mm-hmm.
So we do everything in-house intentionally, but there are decent outsourced companies depending on the level of sophistication. So you can do a quality of earnings, you can outsource that, you can have various levels of due diligence outsourced. What we found is it's very important to invest in the creation of skills for people you employ, right? So when you spend money, you're not getting that knowledge that they're gaining from every transaction they're evaluating. I would much rather have my head of accounting and finance learning from every due diligence what to look for and what to spot. I'd rather that knowledge coming to my team, not some outside vendor. So I prefer that to be in-house. There are fine, as you're getting started, you can get a fractional CFO if you don't have one, right? Say you have a bookkeeper, and a fractional CFO can get you to your first transaction, and then do what we did, which is we looked for that buyout provision. Our CFO did our first deal. It was fractional. We were just getting started. We didn't have the full team yet. You don't start an aggregation company until you buy a company, technically. And so we had someone who was supporting it. He was only on the job at that firm for 1 month. We were basically the first client, and it was a $75,000 buyout provision. We said, done, because he did a deal with us. And after doing a deal with someone, you bond and you go, I want to do more deals with them. Your transaction attorney, your CFO, the people who are around as you're closing deals, those are people you want on your team for the next deal, because you want to take the lessons of the first and apply to the second, apply to the third, apply to the fourth. If you are loaning that knowledge from other people, it's very hard to capitalize on building a programmatic engine, right? You want everybody to get better together.
Cool. If you're raising a fund for capital to go do acquisitions, what are some of the different financial models as far as payback on terms? I've heard a lot of it's like 80-20, some of it's 70-30.
Yeah.
What are your favorites?
So I would first push back on raising funds for deals first. So my beginning statement would be, if you've never done deals, do your first few deals without getting other people's money, other than debt, influencing your decision making, right? Because you work for them. You're going to fail your first few deals. And they still may make money, they still will be successful, but they're not as good as they could have been. So if you haven't proven you can do deals, at least I shoot for 5, right? Show me that you can do at least 5 deals on your own. Don't go get other people's money to commit for you doing deals. Next, when you look at how to fund or build funds, it's outside my level of comfort. There's definitely more Tom's, but that's why I partner with people. It's very simple. If I want to do deals, I don't want to run a fund. I don't want to use other people's money. I want to use it. I don't want to go get it. So what do? If you don't know how to build a fund, you partner with someone who builds a fund, right? Always have people who've done it before doing it with you, not for the first time. You don't want the first time to swing a bat being when you got to hit a grand slam. And oftentimes people are taught through various educational programs, I'm going to start a fund. I'm going to start a fund and I'm going to do a roll-up. And then when you go to market and they go, how have you done this before? Have you bought any companies? It doesn't work out. So even when you get into the nuance, there's percentages, you can be the overall managing partner, and you can do a percentage of commission based on performance of the fund. You can structure funds in a variety of different ways. At the end of the day, if based upon this room, you are not raising a fund to do M&A deals to start, right? And once you've done M&A deals, you are not the person raising a fund. You are going to go find someone and acquire them or get them to partner with you to do a fund, right? Because we can't learn all the roles. You can't be the CEO that does all the jobs, or else you will always micromanage and you won't give up control.
Thanks for listening to the Scaling Fastlane podcast. If you enjoyed this content and are looking for a more immersive experience, join us at the next Scale at Speed live event. It's packed with dynamic content, expert insights, and a room full of like-minded, action-oriented agency leaders. Come elevate your scaling journey in person. Visit scaleatspeedlive.com to ensure your spot today. We can't wait to see you there.